Hi, business owners. My name is Stacey Stanley Young, and I run Stanley Young Business Strategies. Today, I want to talk about business taxes and how that's important to you as a business owner here in Canada. I'm going to talk today about sales tax, payroll tax, and income tax. I'm not going to get into tobacco tax, gas tax, or liquor tax for today. That will be for another video. Let's start with sales tax. We have two different types of sales tax here in Canada. We have a provincial sales tax and we have a federal sales tax. Provincial sales tax, also known as PST or RST, retail sales tax, is a separate tax charged by some of our provinces here in Canada, and it is based upon goods and services that we sell. It is a tax that I like to call the last person who touches it pays it. So if I am selling you either a good or service, I will charge you PST and I will collect that and I will remit that to the government. If I have to pay PST to my vendor, it is an expense to me, unless I am reselling that item. So I go to my vendor, I purchase widgets, and I resell those widgets. Then I can let my vendor know that I'm going to be reselling this and that I'm not the final user of that item. Therefore, I won't pay PST with my vendor. I will collect PST with my customer and remit that to the government. GST, known as the goods and services tax, is the federal portion of that sales tax. And in some provinces, they have combined the federal and provincial portion and called it HST, or harmonized sales tax. For the purpose of bookkeeping and accounting, GST and HST are kind of the same thing, at least in the way that we treat it in the books. So we're going to talk about that interchangeably today. GST or HST is a consumer tax. It is not a business tax. When I sell a good or service to my customer, I charge them GST, HST, I collect it, and I need to remit that to the government. But it's not a business tax. And you're going to tell me that when you go to the store or when you get your vendors, they're going to charge you GST, HST. And that's true. You're going to pay that to that vendor, but you're going to keep that figure totaled so that when we go to remit our GST or HST return, we will turn around and say, this is the HST or GST that we have collected from our customers, but here's the GST, HST that I have paid out to vendors. We're going to net those two numbers out, and that's the amount that we're going to remit to the government, or we're going to claim a refund from them. So here's an example. I have made enough sales that I have collected $4,000 worth of GST, HST. I'm going to let the government know, hey, I owe you $4,000. But in that same time period, I have made enough purchases that I have paid $2,500 out to my suppliers. So I can go to the government and say, I'm going to make a claim for $2,500 worth of GST, HST that I have spent. What we're going to do is we're going to say, I owe you $4,000. You owe me $2,500. So I'm going to net those two numbers out. I'm going to pay you $1,500 and all is well. If in that same period, rather than making enough sales that I've collected $4,000 worth of GST, HST, I've only made enough sales to collect $2,000 worth of GST, HST. I still made $2,500 worth of GST, HST-able purchases. What I would then turn around and do is say, okay, government, I owe you $2,000, but I'm going to make a claim for this $2,500. We're going to net that out. You send me a check for $500 and all is well. Payroll tax. Congratulations. You are big enough that you have employees. But now you have the pain of those payroll taxes, what are also called mandatory employer related cost, or MERCs. So I pay my employee hourly, salary, whichever. I pay my employee, and from their paycheck, I'm going to deduct CPP, or the Canada Pension Plan. I, as an employer, am going to match that dollar for dollar. So for every dollar I pull off of them or deduct from them, I'm going to match it with a dollar. I'm going to then send that on to the government. Employment insurance will also be deducted from my employee. So for every dollar that I deduct of employment insurance from my employee, I, as the employer, are going to match it. I'm going to multiply that 1.4. So I'm going to match it with $1.40. I'm going to collect that together, and I'm going to send that off to the government. I'm also going to collect income tax or deduct income tax off of my employee, but I'm just going to send that on to the government. So in that case, I am simply a middleman. But remember, all of that money belongs to the government, not the business owner. So make sure you are paying attention to that figure and that you're putting that away. The employment related costs that we have for an employee, if you are wanting to budget, how much is it going to cost me to bring in an employee? Remember, whatever salary that you are going to pay them, it's going to cost you about 1.5 times that salary. That doesn't only include MERCs. That's also going to include vacation time, stat holiday time. It's going to include training time, any WCB, WSIB, Workers' Compensation Board type things. So when you are budgeting for an employee, make sure that you're budgeting 1.5 times what you are paying them. Lastly, we have income tax. So income tax works kind of the same way if you're a sole proprietor versus a corporation. It's just different forms that you're going to fill out at the end of the year. So let's start with a sole proprietor. If I'm a sole proprietor here in Canada, my business income tax that I'm going to fill out is actually the same income tax that I fill out every year, my T1 return. The difference is I'm now going to add another schedule, and that will inform the government I have a business, this is how much I've earned in the business, and it will calculate that tax on it. Remember, as a sole proprietor, you are not an employee of the business. You might have employees, but you cannot put yourself on payroll. And any money that you draw from your bank account and put it into your personal bank account is a draw. It's not expense to your business. It simply is like moving money from your savings account to your checking account. There's no tax obligation when you move money from your savings account to your checking account. There is tax if you earned interest on that savings account, or if you're lucky enough to earn interest on that savings account. Same type of thing with businesses. So remember, any drawings that you make on the business isn't an expense to the business. Now, you are going to pay attention to that net income number. You're going to take your gross revenues. You're going to subtract your expenses. That's what gets you your net income. And if you're a sole proprietor, you're going to look at that number. You're going to multiply that number by 30%. And if you take that figure and put that away in a savings account as an estimated income tax expense at the end of the year, I guarantee you that you will always have enough money to pay your tax obligation. Now, 30% is a bit heavy-handed, but I can't take into account any children you might have, any other tax credits that you might be facing, because I am only looking at that business. So 30% is that figure. If you are a corporation, you can put yourself as the shareholder onto payroll. There are a couple of things in there in terms of EI and who owes it. That's, again, another discussion, but you can put yourself on payroll, and any payroll that you pay yourself is an expense to your business because you, as the shareholder, are filing that with your income tax. As a corporation, if you're wanting to estimate what your tax obligation is going to be at the end of the year, you're going to take your gross revenue, You're going to subtract your expenses. You're going to look at that net income number. You're going to take that net income number and multiply that by 22%. That will give you an estimate as to what your tax obligation is going to be. Again, I'm not taking into account if you get the small business owner tax credit, if you have any other tax credits that are available in there, et cetera, et cetera. I am just looking at if you take that net income number and put away 22% in a savings account, one, you're not going to be shocked when you get your income tax at the end of the year, and two, I guarantee you'll have the money to be able to pay that obligation. So that's a basic and a very quick summary of sales tax, payroll tax, corporation tax. Even though we call them the same thing, they're all very different. Those departments do not talk to one another. So if you have collected a whole bunch of input tax credits, they're going to pay you the refund, even though you might owe for your source deductions, because those two don't net each other out. If you are getting a refund from your corporation income tax because you've made installments. Anyway, if you're getting a refund, and again, you owe for GST, you can't turn around and say, well, just apply that refund to the GST, because they are different departments and they don't talk to one another. So we need to take care of these, all these taxes individually. I hope that helps. If you have any questions or need any more explanation on any of these taxes, please feel free to reach out. You can be found at clientcare@stanleyyoung.ca.